So how to get a loan for a fixer-upper. And this could be a house, this could be an apartment, but let's talk about money. So here's where the money is to help you get started buying and fixing. So in this video today, I'm going to show you where to get the money to buy and start fixing property and making money. So I'm going to show you how I find the lenders. I'm going to tell you what you should expect to pay. I'm going to reveal what people charge. I'm going to talk about how to have no payments while you're fixing the property so you're not burdened with making those payments. And I'm going to explain to you the lending formula. And finally, I'm going to give you the insider scoop on these loans right now. So I used to own a mortgage company years ago, so I'm very familiar with real estate finance, and I've also done a lot of loans, like hundreds. So I kind of have a pretty good idea of what goes on with private money. I did a lot of private money. The private money business, the way you find private money guys and gals today is you just Google for hard money, private money lenders, and they're out there. And what you're going to ask them is, what's your cost of money? What I mean by that is, like we talked about in other videos, if you need money, you just go buy it, okay? And of course, you have some qualifications to be able to get it. But right now, we're talking about the cost of money. So a point is 1% of the loan amount. 2 points is 2%. It's also basis points. 100 basis points is 1%, okay? 200 basis points is 2%. So in lending, we often use the term basis points, which is just breaking down 1%. So 1.5% would be 150 basis points. 1/2 of 1% would be 50 basis points. You follow? So that's what basis points is. So all lenders charge basis points and they charge a spread. Typically they get money for a certain amount and they charge more. In other words, they buy and sell money for more than they pay for it. And they have a lot of places they may get it. They may get it privately. They may get it from institutions. Banks may get it from the feds, but everybody gets money and then they lend that money and that creates a spread, which is the difference between what they bought it for and what they sell it for, and that's how they make their money. So that's interest rate. And you're going to ask them what they charge. Typically, your private money people charge 7, 8, 9, 10, 11, 12% per year, and then you make monthly payments. The other thing they charge is points. Points is a fee to borrow the money. 1, 2, 3, 4, 5 points. Most private money lenders are anywhere from 1.5 on the low side to 5 on the high side. Typical 2, 3, 4 is not that uncommon. So that's what you should expect. When you call a private money lender, you want to ask them, they're very competitive, they're all looking for deals. You want to ask them, what's your cost of money? So that means what's your interest rate? They usually give you a range depending on the property and what it needs. And then you're going to ask them, what's your fees? Because they're going to have fees, an underwriting fee, inspection fee, loan doc fee, right? Title escrow fee, and then an appraisal. What does the appraisal cost? Okay, all of those fees are part of the private money lending business. And they were also going to ask you as well, what is your need? Like, how much do you need to fix the property? What is your intention? What's your budget? What do you plan on doing? Now, I don't think this budget's like something you're going to spend 4 hours working on. It's like, look, I need 2 new bathrooms. They're going to be $4,000 a piece. I need a new kitchen. It's going to be about $8,000. That includes the countertops. Flooring's going to be, $7,000, et cetera, et cetera. So I'm going to need $30,000 to fix up this house, or I'm going to need $300,000 to fix up this multifamily property. Typically, they will lend you that as well as part of the loan. In terms of loan to value, typically they will go anywhere from 65 to 70% of the purchase price and 70 to 75% of the repaired value. Some will go higher. What do I mean by repaired value? Repaired value means what's the value of the property after it's fixed, after it's painted, windows, remodeled, whatever you're doing, landscaping, etc. What would the property be worth? So typically you see even on TV, you'll see properties where a person say, I bought this property for $250,000, and then after I was done, right, I sold the property for $375,000. And even though I bought it for $250,000 and I sold it for $375,000, I spent $50,000 fixing it. So I was into it $300,000. So my potential profit was $75,000 after my cost of sale. Does that make sense? It's all about math and it's all about percentages, and it's pretty straightforward, pretty easy. A $300,000 home, if they're going to lend 70% of that, it's around $200,000, $210,000, right? That's how much they'll lend. So where do you get the difference? Well, you're either going to come in with cash or you'll find a private money lender. Some of them will lend you 100% of the purchase price, as long as they're at 75% of the repaired value or 70%, but they'll control the money. They won't give you all the money to fix it at once. They always hold it back and release it as they come out and inspect the property and make sure that you did do the repairs that you said you did, right? So they're not just going to release the money to you, and that's how that works. Now, before I go into the last little bit, don't forget to subscribe so that you can learn from a 1%er, a guy who really does it every day in the real estate business, how to invest in real estate, how to make money, and how to do all this stuff, okay? Because it is doable, but you want to learn from somebody who's doing it, right? Okay, so don't forget to subscribe. You know, the reason all these professionals are licensed in mortgage and in real estate and in law and in doctors is to protect the public. So these people have an ethical obligation to do you right. So that's why you use these people to get loans, to buy real estate, to help you. I'm teaching you for informational purposes only. I'm not a lawyer or a mortgage guy or a realtor or any of that stuff. What I'm here to show you is stuff that I've done and information I've acquired through my experience in real estate. But when you do your real estate, you want to make sure that you consult with and talk to professionals to help you. I also have told you many times on these videos that you want to have a group of people that you're talking to who are in the business, because they're going to advise you and help you, and you're going to learn, and your knowledge base will go up in time using these people. So when we talk about things like ARV, which is after repaired value, you know, those are common terms in fix up loans, right? But you don't know what that is. So you may talk to somebody and they say, and what's the ARV value? And you're like, what the heck are they talking about? Well, that's why you want to have these people around so you can learn these terms when you go to get loans. We talked about not having to make payments during the loan process. And the way that's done is you can ask the lender to pre-fund the first few months of payments. So while you're fixing the property, you're not burdened with having to make the interest payments. Sometimes they'll do 3 months, 4 months of interest payments. They'll hold that and just draw off of that while you're doing the repairs. So that will be part of the budget. There'll be the actual repairs, and then there'll be interest or payments for the first 3-4 months. By the time you have to start paying the loan, you're pretty close to being able to sell it, so you can pay off the loan if you're fixing to sell. Or you may be along far enough to where you have fixed and re-rented, and now you have the cash flow to make the payments. You do that for 8, 12, 15 months, and then you may refinance and pay off the higher interest private money loan. What you'll find typically in the business is that some properties that have a lot of value, your typical institutional lenders will not lend on them in the condition they're in. But once you fix them and you get them stable and you show income for a number of months and the expenses are stable, then you could go to a more institutional lender with lower rates and refinance out perhaps some of your cash, as well as pay off the private money lender who has a higher interest rate. How do you get from a property that is a disrepair to a property that looks pretty again? Is you need these interim loans, some kind called bridge loans or private money loans, where you can get the money to acquire the property, repair the property, and then eventually refinance, sell, or hold the property, whichever you decide to do. These are very important loans that are used all the time in real estate. Everybody uses them pretty much who does, especially value adds like I do. Once you have a couple good lenders, I mean, that really is the key. See, I could find good deals all day, but if I can't find the money, I can't get the property, right? Not just my end of it, but the majority of it to get the property. And as you develop a track record with the lender, they're willing to do more things for you and work with you. The whole key to get started is what? You're going to go on Google, start finding stuff, and then start meeting people and start learning the business and finding out what's possible in terms of your local market. I'm Paul Maguire. Don't forget to subscribe. I'll see you at the next video.